Welcome to the All Facts Matter podcast, where we push back against corporate media propaganda with facts, evidence, and data. I'm Peter, the author of All Facts Matter. Let's begin. Financial journalist Charles Payne said something interesting the other day on Fox News, touching on the final Consumer Price Index summary report for 2024. Expectations and narrative. That's the game Wall Street plays. Now, this is a singular defect of how the media typically reports on economic matters. Corporate media experts in particular have a pronounced tendency, a la Wall Street, to interpret the data so as to fit a prevailing expectation or narrative. Lost in the mix is the answer to the one really important question. What does the data actually tell me? The final inflation report of the Biden-Harris administration is sufficiently muddled, and perhaps even contradictory, that it makes the question seem particularly relevant. What does the December Consumer Price Index summary actually tell us? Now, with Donald Trump about to be inaugurated as the 47th President of the United States, and therefore about to take the helm with regards to the federal government's stewardship of the economy, it's worth chewing on that inflation data a bit to see if there are any answers that we can glean which do not rest on this or that media narrative. Is inflation calming and cooling down? Is the current calm merely the prelude to a new storm of hyperinflation? Let's see if the data is willing to answer these questions for us. By and large, corporate media viewed last week's Bureau of Labor Statistics inflation report in a positive light. CNBC called the data benign. Fox News was somewhat more cynical, noting that energy and food prices drove the bulk of the overall rise in the December CPI data. And while the aforementioned Fox News host Charles Payne emphasized how prices were still high for many goods and services, the overall tone of the article, and Fox News reporting in general, was in line with that prevailing narrative that inflation was, on balance, still getting better. Now, if corporate media was guardedly optimistic about the inflation numbers, the alternative media was not. Alternative outlet Zero Hedge focused heavily on the reality that the inflation data in December climbed noticeably upward. Now, Zero Hedge is taking a longer perspective, noting accurately that consumer prices rose quite a bit during the soon-to-be-ended Biden-Harris administration. Now, is that the same as saying that prices are rising faster now? No, not at all. And that's important to remember when assessing the Zero Hedge narrative. Inflation has not been just bad, but extremely bad. And how much of the consumer's current economic circumstances is a residual of earlier out-of-control price rises will forever be a topic of some conjecture and theorizing. Now, Wall Street, for its part, took the data in stride, and it was quite pleased with it. Equities moved sharply higher in response to the report being released. At the same time, bond markets bid the Treasury yields significantly lower all across the yield curve. And the timing for both equities and Treasuries leaves little doubt that the moves were in response to the CPI report being released. Now, these market responses could, and perhaps should, be considered at least somewhat anomalous, because energy prices in particular had been signaling renewed inflation for most of December. Gas prices at the pump especially moved upward on the month. Now, despite the clear pricing signals in the marketplace that energy prices were rising and that energy price deflation was coming to an end, Wall Street managed to respond positively to the report. Hence, stocks rose and yields fell. Whether Wall Street looked at the inflation data and concluded that consumer price inflation was actually cooling off, or whether Wall Street is pricing in some other agenda, leading to the good-bad news phenomenon we've seen in the past, is not clear. But it is clear that Wall Street was rather happy with the report. Regardless of whether the CPI print shows consumer price inflation itself getting either hotter or cooler, one reality is crystal clear. Wages have not come close to catching up to consumer prices after the 2022 hyperinflation cycle. If we index the headline consumer price index data, the core index data, less food and energy, and the average wage data to January of 2021, it is immediately apparent that wages lost considerable ground to consumer prices during the hyperinflation cycle of 2022 and has yet to make it up. Wages are still lagging, even though wages were doing better in 2024. In most months during 2024, average wages in the United States rose by a larger percentage than consumer prices. From a worker's perspective, this is always the desirable trend. Wages rising higher than prices means workers have more money in real terms. And this is the point that Zero Hedge was hammering, and with good reason. If we index the inflation data and the wage data to January of 2021, and then net the two index values against each other, which is to say we subtract the average wage index from the consumer price index, we can see just how much wages need to rise to fully offset the effects of the 2022 hyperinflation. All of this red is wages losing ground to inflation. And until this chart trends back down to zero, wages will not have risen enough to fully offset the relative pricing effects of consumer price inflation. And ominously, in December, the variance between the consumer price index and the average wage index ticked up again, instead of ticking down. While it is too soon to declare a trend reversal, it is not too soon to note that 2024 wound to a close with workers losing money in real terms to consumer price inflation. Now, against core inflation, the story is a little better. There, the disinflationary trend continued in December, even when netted with average wages. Now, this chart likewise has to move down all the way to zero before wages will have fully recovered against the effects of the 2022 hyperinflation. But wages are doing better against core inflation than against headline inflation. Now, the energy price signals themselves were spot on. Energy price inflation did heat up significantly in December. Energy prices rose by a greater month-on-month percentage in December than they had for all of 2024. And if energy prices continue to trend higher, energy prices will soon pull the headline consumer price index significantly higher. Energy price inflation invariably leads to elevated consumer price inflation. However, while food prices did not rise by quite as large a percentage month on month as they did in November, the rise was still significant. What we are seeing in the last part of 2024 is greater food price inflation than we saw earlier in the spring and in the summer. Now, over the longer term, what makes December's energy price rise uncomfortable is that it comes while energy prices are still 30% higher than they were in January of 2021. Energy prices underwent a large and relatively sudden increase during the 2022 hyperinflation cycle. They showed the greatest relative price increase of all price categories, and so much so that it is difficult to put them on the same chart as other price categories. The energy price increase dwarfs that of all other prices. While they were relatively quick to surge up, they have been considerably slower to come back down to earth. Over the longer term, food prices have also been trending higher since April and May of last year. With food price inflation also having been significantly greater than headline consumer price inflation in 2024, Food prices continuing to move upward means that consumers can count on continued pain at the grocery store checkout counter. Food price inflation may not be getting dramatically worse at the moment, but it certainly is not getting any better. But while energy and food have shown at least something of a disinflationary trend, services overall have not had much, if any, disinflation. When the index chart for services approximates a straight line, and we can see that it does, we may be certain that the rate of inflation has not altered much, if at all. And if we look at the service price inflation month on month for 2024, we see that in the last half of the year especially, the fluctuations in the inflation rate were minimal. While not rising as they did during the 2022 hyperinflation cycle, service prices are still not showing as much interest in getting back down to the Federal Reserve's holy grail inflation rate of 2% year on year. Now, if energy prices continue to rise as they have been, and we see energy price inflation return, as it is showing that it might, if we put that resurgent inflation alongside existing service price inflation, that suggests headline inflation especially could rise significantly over the near term. We may be starting 2025 with an extended uptick in consumer price inflation. Yet while we are seeing numerous indicators that inflation is trending up, wage trends have mitigated at least some of it. When we look across nearly all food categories, we see that the labor cost for food items has been trending down, especially in the last half of 2024. The labor cost, readers will remember, is obtained by taking the average price of a food item and dividing it by the average hourly wage, thus indicating how much labor is required to earn enough to purchase a set quantity of that food item. And we see this decline with breads and starches. Especially from August onward, the labor cost went down. Dairy products were a little more volatile in 2024, but for the most part, they also moved lower during the year. And the labor costs for beef and for pork, while they had risen during the first half of 2024, they began to trend down again in the second half. We see this from August onward with beef, and we see it from about July onward with pork. The labor cost for chicken was trending down pretty much throughout 2024. From January onward, the trend was getting lower. Now, eggs were the major outlier in this trend, as they moved significantly higher, especially during the latter half of the year. We've all seen in the news items about how the prices of eggs are going up and up and up. Now, the labor cost is going up and up and up as well. Now, what do these trends mean? They mean that, in broad strokes, people could work less and still buy the same amount of the same types of food items as before. Alternatively, these trends indicate that food purchases are taking a declining portion of the weekly paycheck for most people. Regardless of what the prices themselves do, if people do not have to work more to purchase the same quantities of the same things, consumer price inflation is not going to be a significant issue for most people. And that's a very positive trend. Now, while corporate media and Wall Street might be taking their usual undeserved victory laps over consumer price inflation, the muddled and mixed trends we are seeing in the CPI data suggest that inflation is not really cooling. Quite the contrary, the data suggests that inflation is, at best, smoldering, and at worst on the cusp of flashing over to a renewed period of significant price rises and even hyperinflation. On balance, The most optimistic conclusion one can reach about prices from the December CPI data is that inflation is not getting significantly worse, while food prices in particular are actually getting a little bit better relative to wages. As a percentage of the average paycheck, groceries are taking a smaller slice of the pie. But the same cannot be said of energy prices, which are taking a larger slice of the paycheck pie. Now, if one goes through the entire consumer price data set, one will find items for which the price rises are significant, as well as items for which prices are even falling. Yet if the more recent trends in energy prices especially persist, consumer price inflation as a whole will quickly head back towards 2022 levels. For that to happen, wages will lose even more ground to consumer prices, just as they did in 2022. The concern is not merely that hyperinflation could theoretically return. The concern here is equally that inflation could rise sharply within the next few months. Now, this afternoon, as Trump puts his hand on the Bible and takes the presidential oath of office for the second time, this is the economic challenge that will confront him. Consumer price inflation that may soon start rising, and rising sharply, but is certainly not falling and not trending lower. Donald Trump has pledged in Agenda 47 to bring inflation further under control. And while it is highly unlikely that any of his policies would prove an immediate cure for past inflation, inflation's current state is raising the stakes. Will Trump even have a chance to begin enacting his economic agenda before an inflation surge takes over and reshapes that same agenda? Wall Street's happiness with the December inflation data may prove to be short-lived. No, the December Consumer Price Index summary does not show inflation surging as it did in 2022, but there are enough potential flashpoints within the data to wonder if such a surge is about to happen. And that concludes this presentation. I hope you found this podcast helpful and informative. Please like it and share this with your friends. Word of mouth is how I publicize my work. Please also consider making a one-time donation or becoming a paid subscriber to All Facts Matter. Your support is what keeps this work going, and I greatly appreciate all of my subscribers. Without you, this work would have no meaning. I encourage everyone to be especially generous with feedback. Leave a word or two in the comments section so that we can keep the discussion going and that we may learn from each other. Thank you all for listening, and have a nice day.